Welcome to PhillipCapital's Weekly Market Watch. We have with us Ms. Hilary Ho, Investment Analyst from Phillip Securities Research. Hilary, on October 10, G7 delegates said that they would take necessary steps to free up credit markets, and we did see markets edging up after the G7 meeting. So could you comment a little bit on the rally?
After the G7 meeting, we saw indexes around the world edging higher. Dow Jones actually experienced the largest gain in a single day. It was up by about 900 points, while Asia market itself experienced a gain of about 4% on the average. Okay, the G7 meeting concluded that financial leaders around the world are willing and ready to use all available tools to help and support systematically important financial institutions to prevent them from failing. They also concluded that it will help to ensure that there is enough capitals in the bank to ensure continued lending to households and businesses. So such actions are actually very important because it helps to restore confidence among investors, and it goes to show that leaders and central banks around the world are ready and willing to take whatever action that are necessary to help stabilize the market. So there is an immense amount of fear in the market right now. So such actions are actually very welcome as they help to calm investors. And hence, having said that, right, any rally at this point in time, it's probably just temporary. Does not really go to show that the market has bottomed out.
Could you elaborate more on why you feel that it is still early to call for a bottom for the equity markets?
It is still too early to sound the all clear for equities as credit lending, the lifeblood of the economy, has yet to recover. Although governments have agreed to inject funds into financial institutions, banks are generally still reluctant to lend. This is evident from the TED spread. The TED spread actually measures the difference in interest rates between 3-month US Treasury yield as well as the LIBOR. As of last Friday, it was at about 4.07%. Okay, although it has come down from the high of 4.6%, it is still relatively high. Indeed, it is also very higher relative to the previous crisis seen in 2001. Okay, hence this goes to show once again that banks are generally reluctant to lend to each other. Okay, with a reduction in the amount of loans granted out, economic conditions will inevitably be affected. As such, we expect investors to start to focus on economic data, and generally on the whole, economic data has not been positive. For instance, we see US, Singapore as well as Japan reporting lower production level as well as export level.
Lastly, could you comment on what to expect for the near term?
I think trading in the near term is still going to be volatile. This is because investors have been reacting in extreme to any negative news, and we expect such behavior to persist as fear continues in the market.
Thank you, Hilary, for your time today. That's all we have for you this week, so tune in next week for more market updates.